Good to go?
I thought I'm going after.
Okay, I think greetings everyone. Thank you for joining us. We still have a few people joining us in less than 5 minutes, so let's be patient as they settle in and we'll get going.
Yeah.
So as we wait, let's feel free. Let's enjoy a video to show you how to use our services as a customer. Just give me one moment to share my screen. Okay, I think we're ready to go. And thank you once again for joining us today for this webinar. We're going to talk about impact of fintech regulations on innovations by SMEs. My name is Constance Oro and I will be your moderator for today. I am the finance manager at Ngamia Holders Platform Limited, and we are glad to host you for this live event. The company Ngamia Holders Platform in brief is a technological outfit with various software products, Ngamia apps that connect consumers with service providers in the transport, logistic, production, and supply chain industry. We are software innovators, engineers, and thought leaders in the industry. We use mobile and web technology platforms to facilitate different business models in the sector. Before I introduce our panelists, I would like to cover a few housekeeping topics. Today's webinar is being recorded. We will be able to share a link with you after the event. We welcome you to revisit the content yourself and share it with your friends and colleagues. Feel free to join the conversations on Twitter. We're using the hashtag Ngamia Africa. We'll also be live on Facebook and YouTube. We'd also like to request you to turn off your videos in case you have them on. Your comments and questions are welcome during the webinar. Kindly look at the Q&A chat box on your screen. If you think of a question for the speakers at any point, just type it in there and I will either pose it to our speakers at the time or hold it after the discussion. Thank you to those who submitted their questions earlier via business@ngamia.africa. Yeah. Today's contributors are Syvia Amayo of Integrated Payment Services Limited, also known as IPSL. Syvia is an account manager at IPSL and is in charge of managing integrations for fintechs, banks, and payment aggregators to the switch. She holds an MBA in strategic management and has over 8 years experience in banking. We also have John Ngida of Ngida Insurance Company. John is currently the actuarial manager at Ngida Insurance Company, handling both the life and general insurance businesses of the company. He holds a first-class honors degree in actuarial science from the University of Nairobi, as well as Masters of Science in Actuarial Management from Cass Business School, London. He's an associate of the Institute and Faculty of Actuaries, UK. Prior to joining Ngamiya, John worked as an actuarial officer at the Insurance Regulatory Authority from 2016 to 2018. John also doubles as a part-time tutorial fellow for the actuarial science course at Strathmore University. I will now hand us over. We can start with Syvia, who will start us off today. She's going to enlighten us on innovation incentives for fintechs and how they have impacted the adoption of fintech solutions. Syvia will also expound on the trends driving the increased collaboration between fintechs and banks. Syvia, please go ahead.
Hi, everyone. Thanks, Constance. Good afternoon or good evening, everyone. Constance, do I just go through everything from the start to the end, or do you want to mention each question and I go through it?
It's all right. Just feel free to just start from beginning to the end.
Okay, great. So I'll start with regulatory incentives that we have for innovators in the fintech space. Now, if you look at incentive, this is in terms of what is provided by regulators specifically to help innovators meet their goals and launch successfully in the market. Now, one of the main things we have from our regulators is RegTech. RegTech is short form for technological regulation technology. Now, it's basically an application or a platform that makes the regulatory compliance more efficient for both the person who wants to innovate or come into the market and the regulator. Now, why do we have RegTech in the market? It's because regulators are required, of course, to monitor or regulate whoever is coming in the market. And in the field of innovation, we have a lot of people who are coming in with a lot of new innovations. Now, regulators are forced to to keep up with these innovations in the market. Hence, the reason why RegTech was introduced. Also, if you look at the government itself, in Vision 2030, it's a blueprint that is meant to achieve a lot of things. Now, one of the main pillars that the 2020 blueprint have is the economic pillar. Now, enhancing financial inclusion and innovations is one of its main pillars in this economic development pillar. Now, if you look at RegTech, one of the examples is, first of all, there's a survey that was done by State Street Global Exchange. Now, this survey says that in the last 5 years, or 5 years ago, people's main concern was data accuracy. Now, and then later, there came concern about relationship between the data that is being brought into the market, or rather the innovations, and what regulators expect people to actually bring into the market. So then RegTech was put into place to make sure the data sources and types are integrated between the financial solutions and the regulators. Now, this helps to bring more alignment between the innovators who are joining and the regulations that are in place. Another benefit of having RegTech is it, of course, provides a platform for other innovators, because if they need maybe certain softwares to be built for the regulator specifically to be able to monitor what is coming into the market, then of course an innovator has the opportunity to be the one to build this. One example is someone like SafariSoft. SafariSoft is one fintech in the market that is trying to develop a regulatory technology system to help financial institutions and regulators to connect. Now, another example is a sandbox or regulatory sandbox within the country. This is being managed by CMA.
I'm sorry, guys. I think Syvia is having a connection problem, so just bear with her.
Oh, Connie, sorry. Can you hear me now well?
Yes, we can. You are breaking off a little bit at some point.
I have someone else who's logged in, so let me see. Let's figure out what to do about that.
Okay.
Thanks. So I was talking about the regulatory sandbox to be among one of the RegTechs in place as an incentive to upcoming fintechs. Now, this is being managed by CMA. What the regulatory sandbox basically does is it provides innovators who are coming into the market to be able to test their solutions before they take it into the market. And this came into place after recommendation of FSD. FSD is Financial Sectors Deepening. It's a Kenyan organization that is in charge of basically deepening the financial sectors with regards to inclusion. So after FSD recommended, of course, CMA, it was put in place and it's being managed by CMA. Now it helps them to not only test their solutions first before it goes to the market, but it provides them with access to several international standards of innovation, just to make sure whatever is brought into the market is up to standard and can stand competition. Now, another incentive we have, in addition to RegTech, is consumer protection. Most of us, I know, are familiar about consumer protection. Now, this is in place by the regulator just to make sure that the consumers in the market are protected, and also the partners by extension. And it ensures issues such as monopoly, need for data and privacy protection, stealing from each other, which happens a lot in the technology industry, is taken care of when it comes to through consumer protection. The sandbox I mentioned now, when the innovators test their solutions before they take to the market, it's also protecting the consumer, because then they assure what the consumer is getting is indeed something that is there to solve a problem, and not just something that I thought about and figured, okay, let me launch it because it's going to give me money, or or rather it's needed by a very small percentage of the population, but doesn't really solve a big problem that exists. Also, when it comes to consumer protection, initially there was still consumer protection, but it was mainly focused on taking legal action against or against each other. That is the businesses and the corporates. But it went down and it was further aligned to protect the individual and even the businesses that are coming through. And if you maybe research further, we have the Consumer Protection Act that was enacted within the Constitution. And there's part 2 of that act. It says a lot and does a lot for protection in terms of people have the right, you can even do a class action if you are aggrieved in any way. People have the right to complain, not just because they didn't get what they wanted, but maybe the standard of service is low. People are even allowed to terminate service before or after it has started, of course, based on a number of factors, or rather rules to follow. But of course, given the consumer protection and knowing Kenyans are saying my right, of course, we have a lot of other people who are misusing it and suing left, right, and center just because there is consumer protection. Another very basic regulatory factor with regards to consumer protection is the requirements for NDA. Constance, I'm sure when we pick up our discussion later with regards to partnership, the first thing we'll need to do is sign an NDA. Why? Because it's protecting myself and yourself such that whatever we disclose to each other doesn't turn out to be adopted by the other person, which, it means I can steal your idea or steal your innovation and go and implement it just because you disclose it to me. So there is the need for using an NDA in order to protect each other, especially with regards to sharing information and stealing each other's now innovative ideas. Lastly, there is financial inclusion also as an incentive, a regulatory incentive to support fintechs. Now, financial inclusion is a focus for regulators because they want to make sure everyone is included in whatever solutions are there in the market. And when we say everyone, it's mostly those who are underserved in the market. So there's a lot that is happening in terms of financial inclusion, just to make sure everyone is included. Now, such incentives exist mainly through a lot of approvals for small and medium enterprises and innovators who are coming into the market. You will agree with me that in the recent past, we've had a lot of mobile lending apps that have been launched, and also a lot of innovations just around M-Pesa. For example, we have a lot of mobile money lenders. We have, everyone knows about Fuliza, which allows you to borrow a loan, maybe mostly because of emergency M-Pesa transactions. We have a lot of fintechs in the market that are helping to make remittances easy. And all these have been brought into the market to help serve that person that probably does not have a bank account or is not able to access a lot of money, or is trying to send money from overseas to their relatives or for some emergencies back at home. So these approvals have enabled fintechs to build these solutions. And at the end, it's of course, helping set up a lot of fintechs and also achieving, of course, financial inclusion for the underserved populations. Now, also another incentive is interoperability. Now, interoperability is basically the ability for all the financial, or rather the players within the financial market, to be able to work together seamlessly, such that the solutions one is providing is able to filter into the other one easily, or they're able to work together to provide a wholesome solution to everyone in the market. Now, when it comes to standards, we have one of the most common standards is ISO, and the current highest standard that is expected in the market is ISO 9001 to 2015. Now, these are also insisted by regulators. It might look like it is being punitive to the fintech that wants to come into the market, but in the end, it helps you make sure when you're launching, then you're launching something that is up to standard. It can play in the international market. And so moving forward, or rather launching other items and more innovations is actually easier for you if you then adhere to the ISO standards and the ISO standards that are set in place by the regulator. Now, for interoperability, you see, I'll give you an example. Currently, you're able to access your money through an ATM, regardless of whether it is for your bank or not. But what about when you go to somewhere that there is no ATM? That is where interoperability comes into place. And some approvals from central bank have enabled this. An example is if you go to cooperative bank, through their innovation, you can withdraw money from your other bank account, let's say KCB or National Bank, from a cooperative bank agent. Now, that is something we haven't seen in the market a lot, but it has been launched recently thanks to regulations and approvals and support. And people who are in the village or locked somewhere are able to access their money, whether they bank with cooperative bank or not. Now, that is for incentives that are in place to help fintechs to be able to successfully launch their businesses. Now, for item number 2 within the topic is how and whether how these incentives have impacted the adoption of fintech solutions in place of traditional banking. Now, the main issue is, of course, it has slowed down the adoption of innovations and fintechs in the market to replace traditional banking methods. But this has both positives and negatives side of it. Now, on the brighter side, albeit being slow, you see, fintechs are forced to test their products before they bring it to the market. What does this do? It makes sure that by the time they are launching, they are sure that their solution is sustainable because it is solving a big or major problem in the market, or rather, it is responding to a very specific consumer need by a big population that is depending on the innovations. Now, also, on the brighter side is there is no regulator in the market for fintechs, the way we have CBK for banks and SASRA for SACCOs. So in the end, of course, it helps the fintechs launch their products faster than any other person. But this has the flip side of it, because as much as they launch faster, they will need to have partnerships with banks and other players. Then they will be asked about the regulations they need to adhere to. Now, this brings me to the negative side of how this has impacted setting up fintechs in the market. Now, first, fintechs are very, very highly innovative. So you'll find that regulators are always trying to run behind the fintechs to catch up. So you see, this means fintechs are at the end slowed down, even though they have very good ideas and innovations in the market. Also, because of the lack of regulation, and maybe there is so many stringent rules for the fintechs, most investors or fintechs, especially who come from outside the country, are a bit uncomfortable in pursuing innovations and investments into the country. So that means the rate at which we adopt fintech solutions or they are set up in the country is a little bit slower because some people are scared or they hold back. when they think about the regulations that are in place. Now, also, some partners may turn away fintechs who are ready and have very good solutions that do not exist in the market. Now, they turn them away because these partners are highly regulated. An example is banks. So you might find that a bank is looking for a solution that is provided by a fintech. Let's say an example is someone like Flutterwave. Flutterwave is a fintech within the Kenyan market that is helping collect diaspora remittances instantly. Now, Flutterwave, when they approach a bank for partnership, because of course they need a bank account at the end of the day, banks may turn them away. Why? Because there's a license they need, there's a ISO standards they need to adhere to, and a lot of other regulations that they need to follow. When this fintech comes into place, they don't have that already. So it means the partnerships will fall out, and people like banks and other players may not really be able to take up these partnerships and support the fintechs. So of course it slows down the pace at which we are taking up such solutions in place of traditional banking, like remittances through the normal SWIFT transfers, which takes 3 days or 1 week, of course, depending on where you bank. And then lastly, some banks or other partners may be willing to take up this partnership, but it will take a lot of time. This discourages some of the fintechs because they will say the regulators or banks or other big fintechs are not willing to partner with us. But you see, well, that may be true, but it's only because banks are highly regulated. It's not really within their control to overlook these regulations that are in place and go ahead and partner with you just because you have a solution, but you don't have the regulations that are in place. So sometimes in the market, we feel that players are very, very slow or even non-receptive to solutions, and mostly fintechs. But ideally, it is not. They are just trying to adhere to regulations, and at the end of the day, of course, to also make sure the consumer is protected. I can give you an example from where I sit at PesaLink. We are the only company or switch that facilitates instant interbank transfers or instant payments. So in a single day, we have so many fintechs who are approaching us wanting to partner. And their use cases make a lot of sense, and they have very good solutions for the market. But we turn away most of these partnerships. Why? Because there's a lot they don't have. There's a lot that CBK tells us that for you to partner with this person, they need to have a license, they need to have such security measures within their system. So we have to send you back to do audit, to get a license, or to set up certain systems on your end. So at the day, we have solutions that are packed, waiting, but it will take some time for them to, materialize and be rolled out in the market for consumers to enjoy. Now, if you allow me to my last question, it's about, or I can just read out the question. One moment, please. Well, there's been a lot of increased collaboration between fintechs and banks. So the question is, what is driving this collaboration between fintechs and banks? Now, we all know what banks have been doing traditionally is account withdrawals, transfers, and there's RTGS and EFT and SWIFT and ATM and agents, which came up in the last few years. Now, fintechs are known to bring solutions that most of them are, of course, to do with payments and collections and aggregating payments for corporates. Now, given this, at the end of each of these payments, there is a good or service for which money has to be paid, or cash. This means a transaction has to take place. And a transaction can only take place through the bank. So that is why there's a lot of partnerships between banks and fintechs, because fintechs need an endpoint, or rather an account where their payments will terminate to at the end of the day. Now, there's also regulations in the market. An example is the amount of deposit that should be held by banks. Now, if you look at someone like M-Pesa or fintechs, they hold hundreds of billions or even, within a month or within a very short span of time. When this happens, central bank comes to question them, because now it turns out MNOs, that is the likes of M-Pesa and fintechs, are holding a lot of money within their system and their wallets to amounts that are only fit for banks. So CBK will come and ask them, you guys, you're holding this amount of billions in your system, and you are not banks. You're not licensed as banks. So we need you to move this money, or you reduce the amount of money that you're holding. So of course, someone like M-Pesa or the fintech cannot reduce their business. The only solution they have is to have a settlement account with the bank. So what happens is all their money is collected, but ideally it doesn't sit in a wallet within M-Pesa or within the fintech's ecosystem, but it sits in a settlement account within the bank. So when you transact, you're transacting through M-Pesa or through Ngamia or another fintech, but ideally the money is coming from an account somewhere within the bank. So of course, that is why there's need for partnerships. Now, another reason why we have a lot of partnerships is banks are really struggling at the moment because money is moving from the banking system to outside. Now, if you look at the fintechs, we have an example of a company called InterSwitch. There's iPay. What these companies do, they are fintechs. They do collections for customers or corporates, and then they disburse at the end of the day after collecting however many millions or billions on behalf of this customer. If you look at other solutions such as Visa does collections. It is outside the banking system. M-Pesa is outside the banking system. Now, this means the money that the banks used to enjoy that is coming into their system, and of course they used to trade, they use it for Forex, they are not enjoying that anymore. So for them to pull this money back into their system and get that liquidity, the only way is to partner such that all these payments, although they are, of course, through the fintech and the MNO, they terminate to the bank, and then the bank has liquidity in their system and money that they can use mostly for trading, let's say on overnight market and in the FX market. Also, we have a lot of partnerships because cash is expensive. People really do not know that. In 2020, cash is still king. We still want to pay with cash. Merchants still want to be paid in cash. Some are still not receptive to Visa and M-Pesa. What most people don't know is cash is very, very expensive, because once this person collects the money, they will need to go to the bank to bank. They will need to do reconciliation in the office. That means there is manpower you hire. That means you hire security like the likes of Wells Fargo, G4S to escort your accountant or your collection officers to the banks. So, and then of course there's the risk bit of it when it comes to transporting a lot of cash. There is the time that you spend to take your money to the bank after collecting it in cash. So the only way to solve this is to make partnerships, or to have partnerships with banks, such that instead of you collecting cash and rushing to the bank to bank it or do transfers, you're able to make collections instantly or straight to your bank account. Then it beats a lot of the disadvantages that come with collection of cash. So of course, this means there is a lot of partnerships between fintechs and corporates that deal in the financial industry with banks so as to beat their increased usage of cash that is ideally expensive, but most of us don't know. But luckily, the fintechs and the banks know this, and that's why they are doing a lot of partnerships to beat cash payments. Of course, to say beating cash payments, I would, of course, not finish without mentioning PesaLink, because that is one of the things we do in the market to enable people collect instantly to their bank account, and most importantly, to help you stop paying in cash. So we are trying to help people collect from big corporates who are doing a lot of collections to the individual merchant who's buying milk, or rather the individual who's buying milk and bread in the shop. Once we have solutions that help you pay straight from your bank account, then it makes life easier. Because imagine right now, if I want to go and buy bread in my local shop here, I'll either do M-Pesa or I'll pay cash. Where did the cash come from? It came from my bank account. Where did the M-Pesa come from? Of course, I was paid to my bank account and I transferred it to M-Pesa. That means there is a cost bit to it. For me to move from my account to M-Pesa or to withdraw from the ATM, then I carry the cash to go to the shop. If we have this solution, or when we have these solutions in the market, then it means I will go to my shop. I won't have to withdraw or transfer money to my M-Pesa and then to the merchants. Till all I will need to do is log into my banking app and pay the merchant straight to their bank account. So of course that has helped lessen the customer journey and reduce a lot of costs. And for the shopkeeper or the merchants, it is much easier for them because, I mean, the money is already in their account. There is nothing more they need to do other than go and do their transactions and make their payments and reduce other costs such as transport and reconciliation and collections. There are teams that do collections in the back office. Constance, that is it from me. So unless there is something I've not covered or questions, then I am more than happy to answer.
Thank you so much, Syvia, for such for sharing such information. So it's safe to say that partnerships with banks, between SMEs and banks, will take long due to regulation, but we'll see more of them.
That's
so
correct.
Okay, so we'll now move to John. We'll save the questions for the end so we can move to John, and he can John will talk more about the regulations in play for insurtechs at the moment, as well as the challenges and opportunities resulting from regulations for SMEs with a stake in the insurtech and fintech spaces. He'll also give us a general outlook for fintech innovations by SMEs in the near future and expected response by regulators. John, please go ahead.
Good afternoon. I hope I'm audible.
Yes, yes, you are.
Okay. Syvia, thanks for your presentation. So I am John, and I was invited to talk about insurtechs. Yeah. So I think I will share my screen. Yes. Okay. Oh, yeah. Not that one.
You shared it, then it went.
Pardon?
You shared it, it was there, then it went. Just share it again, please.
Okay. Technology. Okay, that's visible now. Is it?
Yes, myself, I can see it.
Okay, so, okay, how do I move through these pages? We are good now. Okay. So unlike fintechs, insurtechs have been there since, let's say, around 2010. So the main focus of any technological application is to provide efficiency, that is, do things faster at a cheaper cost. Yeah. So in as much as technology has been advancing fast, insurance has been left behind, unlike fintechs and banks. Yeah. So I was looking at a few statistics on insurtechs, and last year there was new capital injection of around $6 billion worldwide. That might seem a lot, but compared to fintechs, that's still wanting. Yeah. And so the main places under insurance where let's say these technologies can be applied to improve processes and cut on costs include, let's say, basically the entire insurance value chain. So from product development, marketing, underwriting, policy administration, claims management. Yeah. So for example, a company would use sensors or telematics in their vehicles so that you only pay for insurance when you use your vehicle. Yeah. It would use like satellite for maybe to track your movements and determine whether there are any fraud related cases when it comes to claims management. Yeah. Wearables for probably mostly it's for underwriting. If you want life insurance, instead of sending you to a hospital, they would already have all that information included, saved in your, whether it's a smartwatch or whatever other device you use. Yeah. So yeah, basically that's that. So the impact in Kenya, we haven't seen like a major disruption, I'm sorry to say. But globally, if you've heard of Lemonade, Lemonade is an insurance company in the US. I think it's the largest home insurer in the US currently. And everything happens. I wish I could have gotten that video on YouTube and shared it. But everything happens online, like from onboarding to payment, and it takes seconds. So the onboarding, let's say 15 seconds, your claim is paid within, let's say, even 30 minutes. Unlike normal insurance, where a claim will take up to 6 months, depending on your insurer. Yeah. Okay, of course, at Geminia, we pay early. Yeah. So we've not seen the same disruption as we've seen with, let's say, Uber or Netflix. Yeah. And that's because for two reasons. Yeah. One, insurance is usually your list. It's at the bottom of the list in your list of expenses as you do your budget every month. Yeah. So you'd go to the salon and buy cake and go for vacation. Then insurance comes. Yeah. So yeah, it's a service that's actually sold. You don't buy it. Yeah. So the second reason is for you to set up a fully fledged insurtech, like a company that provides insurance. Yeah. The investment, it's risky first, then the investment is immense. Like currently, I think you need around 600 million to set up a general insurance company in Kenya. Yeah. So that investment, no one would be willing to put in that kind of investment. Yeah. So mostly, insurtech proponents or founders, they prefer to work with the existing insurance companies. And when you work with the existing insurance companies, there's that there's the fear of change. Yeah, wherever you are, like the people will fear the change that you're coming with. So basically, that's why the penetration has been very low, very minimal in the insurance space. Yeah. And then a few regulations that limit the number of things you can do, like online, like a policy document has to be a hard copy, signed, yeah. So e-signatures are just entering the insurance space recently, yeah. And still, it's just a provision that out of a gentleman's agreement, it's not that the law backs it, yeah. So you would still need to pick like a physical policy document from an insurance company, in as much as insurance companies now are able to issue these documents online, yeah. Then, okay, on to regulation. So like fintechs, there's no specific regulation targeting insurtechs, yeah, especially here. So if you look at in the US, yeah, they have what we call the National Association of Insurance Commissioners. So in the States, every state has its own insurance regulator. And then the commissioners, who are the CEOs of those regulators, have a national association, yeah, where they meet and share ideas, come up with new regulation and stuff like that. So they have a task force on InsurTech, yeah, which looks into what are the hurdles, why aren't we, what are the hurdles into getting into the insurance business for these InsurTechs, yeah. Similar to the UK, the UK has the Financial Conduct Authority, yeah, which has mostly it's what regulators have been doing globally is creating sandboxes. So I think Syvia really touched on the sandbox concept. So you create a test environment where we relax the laws for you to get into the market, yeah. So CMS tried it, IRA launched it. I'm not sure where it's reached or the impact so far, but I know it is there for a few of the insurtechs in the country. So with that, the regulators feel like with relaxed regulation, probably the requirements on capital and on just consumer protection, data protection, if we relax some of those laws, then we'd have more insurtechs in the market. Yeah. Something to mention, in the UK, it's easier for the insurtech players because UK have a different structure of regulation. They have two regulators, whereby the Financial Conduct Authority only regulates conduct. So consumer protection, consumer data, in terms of the contract structuring, yeah. And then they have the Prudential. Prudential is now more concerned with the Prudential Regulatory Authority, the PRA is concerned with prudential guidelines, basically capital adequacy, are you capitalized, yeah? Are you solvent, yeah? So in that way, because now insurtechs will be dealing mainly with the FCA, it's easier to get insurtechs in that market. And if you look at like the global list of, let's say the top 100 insurtech companies in the world, you'll find that at least 30 are from the UK, maybe probably 40 from the US, and then the rest of the world now fights for the other slots. Yeah, that's because of the regulation. It's easier. There are fewer hurdles to get into the market than the Kenyan market, if you compare. Yeah. So yeah, I guess that's it. So yeah, if you look worldwide, there are players like Zego, Contemplate, Risk. Risk is actually the sole provider of BMW insurance in the UK currently. Yeah, and in Kenya, the three named, there's Bima, there's Waz Insure, and there's Bismart. Yeah, so basically, that's the insurtech space in Kenya. Unless there are any questions, I'd be glad to take them.
Okay, thank you, John, for sharing that. Clearly, InsurTech has shortened the time it takes to get cover. it has made it smoother according to the information you shared with us. So I think there's a question from from Jonathan Dede. He's asking, how do goods in transit work? Question to Jonathan, goods in transit cover? Question.
I guess that's to me, okay?
Yeah.
Yeah, so how do goods in transit cover work? Now, goods in transit, there are two types of cover: a single journey cover or a periodic cover, like you can do quarterly or annually. So basically, you declare what you carry, right? So if you're transporting fish, then the estimate of the amount of the sum insured will be done based on the amount of fish that lorry can carry over that period, and then you pay premiums for that period, and then you're covered. If it's a single journey, then you just cover one journey, yeah? So you travel with the tilapia from Kisumu to Mombasa, and once you get to Mombasa, the cover lapses. If it's periodic, then you can transport goods from Kisumu to Mombasa until that period. So for that period, you're fully covered. So basically, what happens is, if there's a damage or an accident, if there's an accident that causes damage, then you're compensated for the full amount of the goods that were carried, but were being transported. Yeah. Sometimes there are certain what is it called? There are certain goods that once there is even partial damage, then you're covered for, you're compensated for the full amount of the whole, and then the rest is destroyed. Let's say, like what do you call it? The juice concentrates that come from Del Monte that you transport. So those ones, they're usually put in like special containers, where if the container is messed up with in any way, then you're compensated for the full amount. I took too long to answer that. Sorry.
Thank you so much, John. There's another question to Syvia. Syvia, there's a question from Ancilla. Question that says, please expound further on how exactly the sandbox is deemed as an incentive to innovators.
Okay, so like I said, the sandbox, it gives fintechs or innovators an environment to test their solution or their innovation before it goes to market. Now, this is an incentive because it's been provided by the regulators in the market to help them test what they are doing. So number one, it is an incentive because it will help the innovator know whether what they are bringing to market really works, because you can only know that after you test. And then, of course, it helps them check whether there's really a need in the market, or rather a problem that they need to solve before it goes to market. Because sometimes you'll meet people and they have very mind-blowing innovations and apps and everything. But the big question usually is there a problem in the market that needs this thing, or really there is no problem? So the sandbox really helps meet that need. And then now it also helps them test against regulations that are there in the market, because they are testing within a risk-neutral environment. So when they do that, they are able to simulate other factors that will be in play once they are live. And of course, that makes sure they test against everything. And when it goes to the market, it can beat whatever challenges that comes into play. So you see, at the end of the day, it comes in to help the regulator have proper solutions brought into the market, but also the innovator to bring in appropriate solutions. So at the end of the day, it's a win-win solution for both the regulator, the innovator, and the end user, or rather the consumer, who will be utilizing the solution that is brought into the market.
Okay, thank you so much, Syvia, for responding to that question. Thank you so much, John and Syvia, for sharing with us. Thank you to everyone who joined us for today's webinar. Syvia and John, your insights and expertise are really appreciated. Any last words before we end the webinar?
Oh, thank
Constance,
you guys.
are you asking last words from us?
Yes, yes.
Well, probably I can go first. I believe fintechs and innovators, for that matter, have come to help make our financial payments and economy at large better, if not really worse. Why we have a lot of push and pull and fights between regulators, fintechs and banks is because immediately a solution, or rather an innovator, comes into the market, the other person feels like they've come to cannibalize on their market or their revenue or their customers. But if you look deeper into it, we are all looking for the same, or rather to achieve the same goal, which at the end of the day is financial inclusion. And it's basically aimed at, you see, we have a lot of people who are banked, but we forget about the other people who don't have a bank account, who don't have an easy way of making payments, or even the other people, not the low income earners, but other people in the market who are struggling to, manage their finances, like collections in the transport industry. If you look at FSD has very insightful reports. And in one of the reports, they call, there's a group of people they call the hustler segment. Now, the hustler segment, according to FSD I said is financial sectors deepening. It's an institution within the country that helps to just drive inclusion, financial inclusion. Now, the person they are calling the people they are calling the hustler segment is low income earners, or people who require daily working capital to get through their day. Now, FSD said this population accounts for 52% of total M-Pesa transactions and 33% of M-Pesa revenue. Still, even despite these numbers, there is still a very large population that is not catered for. So you see, this means there is a very huge opportunity for fintechs and mostly innovators in the financial industry, because they have a large market that is yet to be untapped. And it's only a matter of either looking for the right solutions or getting the right regulatory support to help them launch these solutions. And then, of course, eventually we'll have better payments and financial systems within the country. So I think it's a good place to be. We really need fintechs. We just need to look more into supporting them and giving workable solutions to the community.
Okay, thank you so much, Syvia. Any last words, John, before we end? Very briefly.
Okay, two things. If you look at the top Fortune 500 companies, their intangible assets have overtaken their tangible assets. Like the intangible assets are 6 times their tangible assets. And we are talking technology here. If you look at the biggest companies in the 90s, ExxonMobil, GE, Coca-Cola, currently we are talking of Microsoft, Apple, Facebook, or Amazon. What's the difference? Technology. So with that, thank you guys for tuning in. Back to you, Constance.
Okay. Thank you so much. If you have any additional questions or you would like to connect directly with the Ngamia team, you can either reach out using the contact information on the slide I'll show afterwards, or you can reach out through Twitter or LinkedIn. Our handles across social media is Ngamia Africa. Please feel free to follow us. Thank you for your time and have a wonderful rest of your day. Goodbye.
Thank you so much, Constance.
Thanks.